Welcome to Dr. Fred Markets. This is not financial advice. Most people will never understand how crypto, AI, and global finance are reshaping the world. The rules are changing, and the ones who adapt early come out ahead. You're here. You're paying attention. That already makes a difference. Let's go.
America's grossest parasite outbreak just turned salad into an asset class. Earnings season starts this week, and Wall Street stares at one number: 8.9% expected profit growth for the S&P 500, with Nvidia dragging the whole index higher like a steroidal draft horse. Under the headlines, food and beverage stocks quietly posted multi-year margin highs last quarter, while the rest of consumer staples whined about cost pressures. At the same time, the CDC tracks a weird pattern. Cyclospora outbreaks in the US spike around imported fresh produce, and every scare clusters around the same thing: washed, bagged, healthy food that stops trading like groceries and starts trading like a volatility product. Here's the part nobody in a Navy suit wants to say: foodborne illness is now a tradable event. Let's talk numbers. In 2018, one Cyclospora outbreak tied to McDonald's salads hit 500 plus people. The stock dipped, sentiment tanked, and then it ripped 25% higher over the next 12 months, while everyone argued about lettuce. In 2021, a multi-state Cyclospora wave linked to bagged salad didn't kill the companies, it narrowed competition. Smaller suppliers ate recall costs and lawsuits. The big guys with industrial food labs simply wrote a bigger QC budget and took their shelf space. Meanwhile, the US fresh-cut produce market pushes past $25 billion a year, growing faster than junk food because boomers fear heart attacks more than diarrhea. So you've got this insane setup: demand for fresh and safe food climbing, pathogens hitchhiking into the supply chain, and only a handful of players with the money and tech stack to keep grocery CEOs off CNN during outbreak season. That's your trade. This is where vertical farming walks into the story, like the weird kid who ends up valedictorian. Traditional farming bathes lettuce in open-air water, soil, animals, migrant labor, weather, and sewage systems older than your grandparents. Vertical farms stack crops in sealed warehouses with filtered water, HEPA-filtered air, sensors, and robots instead of field crews. Cyclospora thrives on human poop in warm, wet environments. Vertical farms strip out human poop in the field. You want one concrete fact today? Pathogens don't travel well through stainless steel, closed pipes, and barcode seedlings. Follow the money. One leading vertical farming company reports 90% less water use, near zero pesticide use, and this is the part Wall Street analysts miss: full traceability from seed lot to clamshell. That's not sustainability marketing. That's legal ammo when everyone else is writing settlement checks. Grocers stare at that and see fewer late-night phone calls from lawyers. Now blend that with earnings season expectations. The index leans on mega-cap tech Nvidia, up almost 3% today, while the S&P creeps 0.2% like a hangover. If tech guidance wobbles, managers scramble for places to hide where margins still expand and regulators aren't sharpening axes. Enter controlled environment agriculture and food safety infrastructure.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Boring, essential, and chronically underowned. Here's the mechanism. Every dirty lettuce headline quietly re-rates the value of indoor, controlled, traceable food production. Insurance actuaries price risk differently. Grocers renegotiate contracts. Supply chains shorten. And the few vertical farms that survive the hype cycle wake up not as meme stocks, but as critical infrastructure for supermarkets that want to stay out of the WCVB chyron about explosive diarrhea. No, this is not the future of farming fairy tale. Most vertical farm startups already died. Power costs wrecked them. Dumb SPACs wrecked them. Management hubris finished the job. Good, the graveyard cleared the field. What's left is a tiny set of operators near dense cities, close to high-margin grocers and restaurants, optimizing like maniacs on energy use and yield per square foot. Those survivors don't need to feed the world. They just need to skim the cream layer of high-value produce where contamination scares are expensive. So what does this mean for you, sitting here watching war headlines, Trump drama, and Parasite news while the S&P grinds at all-time highs? First, understand the signal. Foodborne outbreaks push political heat onto supply chains. Politicians scream, regulators posture, but retailers act. They reallocate shelf space toward vendors who prove control, traceability, and indoor production. That is a quiet, multi-year subsidy for vertical farming and food safety tech. Second, understand the business model. Vertical farms are not farming plays, they're logistics and risk transfer plays. They sell three things: consistent output near cities, lower recall risk, and a cleaner ESG story for big box grocers and restaurant chains terrified of the next lawsuit. Their real asset isn't the lettuce. It's the data and control systems that track every leaf. Third, understand your action. This is not financial advice, but here's the truth. If you want exposure, you don't spray money at every hydroponic clown with a deck. You build a watch list of publicly traded vertical farm operators, greenhouse REITs, and food safety testing inspection companies. Then you do one hard thing. Wait. Wait for the next big US parasite or recall headline that turns healthy food into front-page fear. When everyone panics about salad, you check which of those names just reaffirmed contracts or guidance, and you scale in while sentiment is covered in hand sanitizer. One surprising fact: pathogens are a macro factor now. One mechanism: outbreaks accelerate the shift from open fields to sensor-stuffed warehouses. One action: treat every scary produce headline like an earnings call for vertical farming and food safety stocks, not just a reason to stop eating romaine. This is not financial advice, but the truth is simple. Your 401k already owns companies that make you sick. Owning the ones that make your food harder to contaminate is just self-defense with a ticker symbol. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.